US dollar index fell 3% in the first week of March, mainly due to the concerns about the economic challenges facing the United States. Financial markets are grappling with the escalating global trade war initiated by President Donald Trump. In light of these developments, the world recession is increasingly appearing in analyst reporting in news outlets. As investors shift their focus to upcoming US inflation data due to release on March 12th and 30th, the future trajectory of the US dollar remains uncertain. The dollar's decline is further compounded by the market now pricing in 3 rate cuts by the Fed Reserve through 2025 compared to initial expectations of 1 over 2 rate cuts in January. Despite inflation accelerating to 3% year-over-year, largely driven by energy prices, market participants expect inflation to cool to 2.9% in February. However, the Fed Reserve faces a difficult decision on March 19th, as weaker job numbers and falling inflation could signal the onset of a recession. Core inflation, which excludes energy and the food prices, is estimated to have fallen to 3.2% in February. If this trend continues, it could prompt the Fed to rethink its plans for monetary policy adjustments before the middle of the year, and this could put additional pressure on the US dollar. The Bank of Canada seems to have no other choice. At its meeting on March 12, the Canadian regulator is expected to lower the key interest rate by 0.25%, and this will mark the seventh such decision since the easing cycle began in June 2024. In theory, the Bank of Canada has got it right, with the GDP growth expected to reach 1.3% in 2024. Forecasts suggest it will rise to 1.8% in 2025 and 2026. However, risks from the US trade restrictions are likely to negatively affect both imports and exports of Canadian goods, putting downward pressure on the Canadian dollar. The Canadian dollar is also tied to oil prices. The full reaction to the US oil inventory report can be expected on a Wednesday. For the week ending February 28th, US crude oil stocks increased by 3.614 million barrels, much higher than the forecast of 0.9 million barrels. The data points to weakening fuel demand, which could further weigh on the oil prices. Compared to the United States, the European economy has been more promising of late. For example, industrial production in the euro area is estimated to have risen from a -2 to -1.7% in January. While the growth indicator is still in a negative territory, the trend is positive, which could contribute to the euro's gains. On a Thursday, the US Producer Price Index will be released. It came in at 3.5% in January, beating expectations of 3.2%. And this is the highest level since February 2023, indicating continued inflationary pressure on businesses. High raw material and logistics costs are keeping prices high. However, if the trend reverses, it could reinforce expectations of a rate cut by the US Fed Reserve, and this may be supported by the US labor market data. US initial jobless claims decreased to 221,000 for the week, down 21,000 from the previous figure, and this was below market expectations of 235,000. However, continuing claims rose to 1.897 million, indicating a slowdown in hiring. As a result, the dollar is expected to react with a decline. Speeches from major central banks are also expected on this day. The comments usually lead to volatility in the currency market, as they can indicate future interest rate plans. Please note that the publication's times are set in a GMT +3. The next video review of our traders' calendar will be released on a Wednesday, March 13th. And now we wish you profitable trading and see you soon.